Good afternoon, everyone. Thank you all for making your time out on a Saturday afternoon and coming to meet us. Also, our online viewers to taking time out to listen to us. Very grateful to that. So, before I start, I'll just introduce who's in the auditorium and on the panel today. So, first off, we have our CIO, Mr. Rajiv Thakkar. Next to him, we have our three fund managers, Ronak, Raj, and Rukun. So famously, they're called the 4 Rs. So along with the 4 Rs, you have the pleasure of two Neils today. One Neil is Neil Borate, who you all would be knowing. He's the deputy editor of Mint. First of all, Neil, just want to really thank you to moderate this session and really appreciate it, you taking time out and coming here and spending your afternoon with us. Thank you. And I'm Neil Parikh, the CEO of PPFAS. Uh, thank you. Thank you. So this is the ninth year we are having our AGMs, and when we started the mutual fund 9 years back, one of the things we said, and we thought which would be really useful, was that having a two-way communication, having this AGM where we can interact with investors, with partners, and more than that, they can ask us any questions that they have, because if we are dealing with your money, and you put your trust in us, then it's your duty to ask us any questions you all might have about what is happening with your money. So that is exactly why we have such meetings. um, can I just get the presentation on? So, before I start, I just need to read this out. Viewers should note that the objective of this meeting is to communicate with our unit holders and share with them our thought process. It should be noted that views expressed here are based on information available in public domain at this moment. Views expressed here can change depending on change in circumstances. Nothing discussed here constitutes a buy, sell, hold recommendation, and mutual fund investments are subject to market risk. Read all scheme related documents carefully. So, while we have that out of the way, this I just wanted to. So I'll just tell you how this will work. So I guess I'll give a presentation in the beginning. Again, my presentation would be just to hammer out and to communicate this things that are important to us when we manage your money, and as investors, what you should probably be aware of, and kind of get to know us about how our process is and how we are thinking about managing money. So one thing is to the best thing for any relationship to have manage expectations, and the expectations should manage, right? I mean, it should match. So one thing is that I'll try to let you all know how we look at investments and what are the things that are important to us. After me, Rajiv will has a presentation. After his presentation, we'll get into the Q and A's that have been sent so far. So the most important thing, and I've been saying it, and we've been saying it for a very long time, is the law of the farm. Uh, the core belief for us is the law of the farm. You cannot sow something today and reap the benefits tomorrow. Just like the seed has to go through various seasons, it needs nurturing, it needs sunlight, it needs your time to become a full blown tree. So does the investments. I think the most important thing is that we need to give our investment time. From your point, give it time. From our point of view, we need to nurture the investments. We need to make sure that we are on top of all the investments we are making, and all we ask you is that give us enough time to perform, because nothing happens overnight, and even we've done there's been so much development in the world, but there's nothing as one seed cannot become a tree overnight. That has not yet come. So it has to go through the natural process. Same with investments, they have to go through the natural process. It takes time for the money to grow. Uh, And then that leads us to power of compounding. Everyone talks about power of compounding, but power of compounding only works if you sorry, one second, just presentation please. Yeah. Power of compounding only works if we hold on for a very long time. In the initial years, you might not see the true potential of the power of compounding. Only after years have gone by is that your money starts really compounding, and that snowball effect really works. So, first of all, this is I've just estimated a growth rate of about 11%. And this is just for illustrative purposes. The chart, it's not like we have these returns or any of that. It's just to for people to understand that if you see how power of compounding works, that the longer you let your money grow, the faster it compounds at the in the end of the period. In the first few years could be a bit frustrating, or you might not think your money has grown that much or that well or something like that. But I think if you hold it on for a longer time, I think you see the true benefits of compounding. So only if you hold your investments for a long time do you see such great returns, that compounding can get. uh, One thing that we try to do, and we are focused on, is avoiding permanent loss of capital. Again, ups and downs of the markets are part and parcel, right? But I mean, we want to avoid the permanent losses, that if something goes down, then it has no chance of recover, or you can't even get your purchase price. One of the things people uh, make a mistake, and something that we are focused is about not chasing a fancy. So when you chase a fancy, all you do is you pay a fancy price. The fancy ends, and you're left with a fancy loss. I mean, beyond that, nothing happens. If you've seen from the tulip mania in the 1600s to currently, if you see cryptos and all that, I mean, the same thing goes on. I mean, nothing different happens in the world. So one thing is that we are pretty. We don't like to chase whatever the new fads or the fancies of the market. What we try to focus is on management quality, the promoter quality. We want high quality promoters, managers. So maybe you won't see us investing in too many IPOs, and one of the reasons we don't invest in IPOs is that we want the managers or the promoters to at least have some track record before we invest with them. If it's a first time promoter or a manager, we would take our time to evaluate him, evaluate that person, and then only put our money if we are comfortable with him. Because in our experience, more often than not, if you partnered with good management, good promoters, good things happen, and it's vice versa. We've also had those experiences. So we are this is actually the one of the key things, that the first thing that we have is the promoter quality. Secondly, we concentrate on business fundamentals than stock price movement, of stock performance. I mean, what we are trying to do is to analyze a business, okay, not a stock price, or if a stock will go up or down. I mean, we look at businesses because we like some characteristic. It has to have monopolistic characteristics, or less debt, more cash, high ROE kind of parameters, right? I mean, and it has to have a future. Again, if we think that the business characteristics are good for it to grow in the future, we'll invest in it, right? I mean, and there have been times where we've invested. I mean that because we invested in something that the price has to go up or any of that. We are looking at businesses to grow, and stock prices don't sometimes move in tandem with business performance of a company. So yeah, so we are more we are more focused on the business characteristics. And lastly, we have to pay a reasonable price for it. How great a business, how good a management, but if it's not available at a reasonable valuation, then we will let it go. We will not invest in that company, and stay away from that, until we're comfortable with the price that to invest. Again, a lot of attention goes into return. And we all talk about returns. But I think more important, what we look at PPFs is risk adjusted return, downside protection. I mean, I think if we could, I think we can protect the downside give a reasonable upside and try to do that consistently, I think we'll do. I think we all will do fairly well, going to the future. So just some parameters here. So again, this is a chart I've taken from Morningstar. The source is Morningstar here. What it says is, and this is our FlexiCap fund, the Parag Parikh FlexiCap fund. It's a 5-year return profile, a risk return profile. What it says that against the category that we are in is the FlexiCap category. The risk versus a category is low, and the return versus the category is high. And those are some of the parameters that they use. I won't take too much time on the parameters, but essentially it says that alpha, or the overperformance over the index, is over 5 years, we've given about 6% extra returns compared to the average category returns, which have been slightly negative. Beta, or the volatility, we are less volatile than the category or the index itself. And standard deviation, which is the measure of risk, we are much less than that too. Again, the interesting thing is, if you look down, the upside downside capture ratio, which is quite interesting. What it says that if the index for us is the NSE 500. If that goes up by 100, the category FlexiCap goes up by 92, whereas our fund will go up by 87. So we definitely are not performing better than the category or the index on the upper side if the markets go up by 100. But look at on the downside, right? I mean, if the index goes down by 100, the category goes down by 95, whereas we only go down by 56. So I think the downside protection is really a good parameter to judge a fund by, or something that we are more focused on is like protect your capital. Like I said, avoid permanent loss of capital. That's kind of what we want to do. And this is kind of what we want to do, is to optimize returns for the long term and not maximize returns for the short term. I mean, when you maximize return for the short term, then you will be chasing the fad and the fancies. You will be taking excessive risk in the short term. You will be chasing the herd, or what's coming, what is the most popular thing right now, to get that quick buck or the quick return. For us, we try to actually avoid that, try to avoid chasing the herd. So you would see at times when markets are very expensive or something, that we don't mind. And if you're not getting any good opportunities, we don't mind being in cash, and we've got cash positions. Or we don't mind investing in neglected sectors or stocks that people are not investing. So we are not trying to maximize return for the short term. So yeah, I mean, people keep telling us about 3 months, 6 months, 1 year performance. So we are more looking at it to optimize returns for the longer term than to maximize in the shorter term. Again, we all have heard about this saying by Mr. Warren Buffett: be fearful when others are greedy, and be greedy when others are fearful, right? I mean, it's easier said than done, right? When a fall comes or the markets are going up, it's very hard to do the opposite of what the market is telling you to do. But kudos to the fund management team. They've been practicing this, and the 3 recent examples are in 2007. This is way before we were a mutual fund. We were a PMS at that time. Again, that was the time of the financial crisis, right? And markets were on a tear, going up. The index was up by 50-60% in 1 year. And we were up by only 11% because we had around 30 or 40% cash in the position, right? Cash position in the portfolio. So we were massive underperformers in that year, in 2007. But 2008 came, and we more than made up for the underperformance of that year or 2 years, And again, we didn't see permanent loss of capital because we didn't invest in stocks which were the fancies at that time, like real estate, power, infrastructure stocks, So we stayed away from that, and which I think helps the unit holders or the investors over a longer term. You might think that period might be a little painful, when the underperformance is there. But that's what we're trying to do, is to not really concentrate on 3 or 6 months or 1 year kind of performance. Will these decisions help us and our investors over a longer term? And would they not lead to permanent loss of capital? And that's a question we asked. That was 2007. Recent example is 2017. In a mutual fund, we were a mutual fund by then. In our FlexiCap, in 2017, we were at the highest about 29 or 30% in cash, right? I mean, at that point, and that was a time when small caps and mid caps were just going up one way. Again, we underperformed that time also. Shorter term underperformance were there, but that cash really helped us later on. When markets actually fell and gave us opportunities, we could buy into companies with good valuation, and that continued all the way till 2020 when COVID hit. When COVID hit, everyone was fearful. Everyone thought the world's going to end, but at that point, we thought that, well, I mean, we're getting some great companies at great valuations, and we have some cash position because we didn't invest in uh, things that were fancy at that point, and that really helped us out. So I think sometimes every few years we get opportunities, and again, if we can maximize those opportunities, it's great. It's not like every day the markets gives you opportunity. It's once in a while. So as long as we can do that, I think over the longer term we should be fine. Yeah, so I keep getting asked, and we keep getting asked, guys, what are you doing about the volatility? Market is very volatile. बहुत volatile है market. क्या कर रहे हो? What are y'all doing? How y'all handling the volatility? All these things. So, I mean, in the end, don't know how to answer it, but just tell those people that volatility is a feature, it's not a bug. It's supposed to be, markets are supposed to be volatile. There's nothing, uh, there's nothing else to it, because it's investors will have to go through these ups and downs, this kind of roller coaster ride. You have to go through some of the bad times to see the good times. You can't just have the good times all the time. So, and because of that, because the markets are volatile, you get lumpy returns. By lumpy returns is that there'll be periods of 2-3 years where you might not get any return, but the fourth year you will more than make up for all that returns. So when we say, when people say I've got 15% CAGR returns, it doesn't mean that every year you've got 15%. There could be years where you've got negative 20%. There'll be years you've got positive 30%. So that's why we say that if you have a long enough, when you have a long enough view about the markets, I think that evens out and you get a decent return. But in the shorter term, that looks pretty scary. Volatility is scary, but it is actually part and parcel of the markets. So there's nothing new to that, and which also will lead to short term underperformance. It's not like any fund house or any fund will keep probably outperforming the markets at any given periods or all given periods. But here, if we're looking at a longer term, we want to perform over a 5-year period or at the minimum, in equity. So this is kind of been the journey of the flexi cap fund over its lifetime. There have always been times of underperformance. I mean, you can see it's against the BSE 500 try and the flexi cap category. There's always been underperformance, and it's not new, and it's not never going to happen also in the future. It's always going to happen. It's always happened also. But I think if we take common sense steps about the portfolio, about investments, about not doing something crazy or following fads and fancies, and just stick to the basic principles of investing, I think we've seen over a longer term, I think the returns have been pretty satisfactory. Again, this is flexi cap. This is the tax saver. I mean, similar journey as such, in the sense that there have been periods of underperformance in the tax saver fund also. But over time, I think if we can manage over a 5-year period or whatever to give like above average returns, beating the benchmark and the category, I think that should be fine. So I don't think we need to stress too much about the shorter term. That's what my whole thing was. Again, investing is supposed to be boring. The day it becomes exciting, you are not investing. So if you want it to be exciting, then I can think of a few more ways other than the stock markets where things are more exciting. I mean, going to a casino or going to a horse races, they're probably more exciting than the markets, right? I mean, you at least have fun doing it. And so, uh, yeah, it's supposed to be boring. And the things that we take care of and what you all can, what investors should do is obviously follow a process or a plan. We have a investing process that we follow pretty stringently, and we don't deviate too much of that. We have our circle of competence in the sense that there may be thousands of stocks that are listed, but we track about 500 stocks in India and globally, and that's our circle of competence. That's what we think is that we are good at, and this is the thing that we know these companies pretty well. And if there are opportunities in this basket, we will take care of them. Beyond these 500, 600 stocks, if some stocks happens to do really well, then so be it. You can't get all the opportunities, or you cannot be trying to profit from every stock in the market, right? I mean, so have a circle of competence. Again, for investors, have a plan, have a financial plan, do a asset allocation, and stick to it. I mean, stick to that plan. That's your circle of competence, because again, there'll be NFOs launched every week. There'll be thematic funds and sectoral funds, and a lot of things that are in the fad and fancy that will be launched. I mean, I think it's okay to not get involved in all of them. Just stick to your plan. If it has like three mutual funds that you're supposed to invest in, then stick to your three mutual funds. You don't need to uh, get into everything. That's my point. And not having FOMO. I think a lot of FOMO has happened over the last 2 years in crypto, and a lot of people we meet, at least the last couple of years, when cryptos and all were rising. They've like just put all their money in crypto, sold off their mutual fund holdings or whatever, and gone there. And I'm not saying any asset class is good or bad. I mean, look, as long as you'll understand, if you understand the risk, you understand uh, the asset or the product, and then you invest in it, that's fine. Do that. That's okay. But doing it haphazardly, or just doing it because you have FOMO, or you think you're going to miss out, or you're greedy that, oh, this is going to give you that extra returns or something, don't do it in that way. So avoid the FOMO, stick to your plan, have a circle of competence. Inaction is sometimes the best action in the market. I mean, if you're confused, you don't know what to do, don't do anything at all. And by that, I'm not saying that just blindly invest and forget about it. No, every year or 6 months, review your portfolio, review what's going right, what's wrong, but do that once a year, twice a year. Don't do it on a weekly basis, don't do it on a daily basis, don't look at anyways every day and see, oh, what has happened, because that those those things will make you make bad decisions. So sometimes just let it be. Just let it be. Concentrate on your what is important to you at that point. So your jobs or your business or any of that, and markets will continue. Don't worry about that. And again, people need to decide if they want short-term excitement versus long-term wealth creation. So, uh, yeah, if short-term excitement is what you want, then yeah, surely, then do what you want. But long-term, if you want to create wealth the longer term, then it is in the beginning. It is tough. You might not see that many. Like I said, the power of compounding only works over time when you hold it for a longer period. So have that discipline and stick to that discipline. Again, we have a fiduciary responsibility when we manage your money. Means fiduciary responsibility means that we do what's good for our investors. I mean, that's kind of what fiduciary responsibility means. And if you are in the financial space, then I think that is kind of paramount to us. If you're managing people's money, that we do what's in your best interest. So one is, we don't have no flavor of the month scheme. So we don't launch schemes very often. The only reason we launch scheme is, if you have one, is that if there's a real need in the market for the product, if we are excited to put our own money in the in the said scheme, and if we think there's a demand or a need from our unit holders, that, or we can create some differentiation in the category, or do it in a better way, then surely we will launch a product in that way. But we are not going to launch products just to gather assets. We are an AMC. AMC stands for Asset Management Company, not Asset Marketing Company. We're an asset management company. So we'll stick to, when we think a product needs to, when we are excited about product, we will probably launch it then. But we will not try to get into uh, every category if we think we cannot do justice to that category as such. So that's one thing. There won't be any flavor of the scheme, or not too many schemes from our side. uh Profession versus business. We are professional. We consider ourselves as professionals. Again, a professional is someone like a doctor, a lawyer, who's supposed to be doing good things for his patient. I mean, that's what a professional means. Like, okay, you go to a doctor, you want him to work for your best interest, right? I mean, you don't want to just be a tick mark for him or something like that, right? So again, what we try to do is, what's in the best interest of our clients, we do it. Business considerations are actually very secondary. I think if our investors, our partners have a good experience, if we can do good things for them, we can perform. I think, yeah, I think business will come, and that'll happen if we do good things. So that's one thing. We have skin in the game, in the sense that we have put our own money along with you all, and we put a substantial amount of our own wealth in the mutual fund. Obviously, right now, I mean, recently there have been circulars where it is mandatory to have skin in the game, and each mutual fund has to. But we've done this long before skin in the game circular have even come out. Uh, we don't do only the mandatory. We do way more than the mandatory that's required. But I think for us, like I said, it's for us. It's exciting to put our money. We like our fund because we can put our money in it, and it's something that's good for all of us. So if it's good for y'all, it's good for us. So we put our money there. Other things when we are doing professional versus businessmen is that we don't have any sales targets for any of our employees. I think if you have fiduciary responsibility, then sales targets don't go hand in hand. If I give sales targets or there are sales targets, then any like people will just sell anything to anyone. Here, there are no sales targets. I mean, we communicate about our funds, and if people think it's good, if it's good for them, and if it's going to help them, then they will invest. But there's no sales targets as such in the organization. Uh, yeah, so we don't have any cluttering of offerings, like I mentioned, and this brings me to survivorship bias. Survivorship bias is basically if you're running 30 schemes, and at any given moment, two schemes will be doing well. So you can always market those two schemes and say, "Oh wow, you've done a fantastic job." For us, for better or for worse, we have our few schemes. The flexi cap being the biggest, and for good, even if it's not performing, we cannot hide behind its performance and market other schemes or anything, and we won't have it any other way. I think we're confident in what we are doing in the selections we've made or the choices we've made, and we are happy to answer those questions, even if in times of outperformance, in times of underperformance, we don't have any survivorship bias. So that's what it is. And we have open channels of communication, this is being one of them, where it's an open forum, and we can all chat and have honest questions with each other, and y'all can ask us anything y'all want to ask us. We have four schemes. If anyone's not it doesn't know, we have our flagship Parikh Flexi Cap Fund, which can invest in Indian stocks as well as foreign stocks. Up to 35% can be invested in foreign stocks. Rest is in Indian stocks. The concept here is like a Swiss Army knife. It's like one device with multi functionalities. So we can take advantage of all opportunities that are there in the market in terms of arbitrage opportunities, special situations, what have you. We can be in cash if it can be a balance fund if you don't see any great valuation, we can be in cash for that matter. Then we have the Parag Liquid Fund. It's for your short-term needs to do SIP, STP. If you all have the fact sheet, then Rajiv has written a note that if you have idle money lying in your savings account, this is a good time to put it in the liquid fund. The liquid fund is giving some going forward decent return compared to your savings or current account. So you all might want to think about that. If you have idle cash lying, put it in the liquid fund. Parag Tax Saver Fund is the basically you get the ATC benefits of 1,50,000 if you invest here, which are tax exempt. But a lot of people have been asking me, why don't you launch this scheme? Why don't you launch a all India focus scheme? And the likes, and we were just internally talking, and we all came to the same kind of conclusion that if you launch another focus scheme or an Indian scheme, it's going to look exactly like the tax saver fund. It's not going to look anything different than the tax saver fund. So if you all want only Indian allocation, then the tax saver is a great option to invest in. The only thing is got a 3-year lock-in, but if we are saying equities for 5 years and longer, then a 3-year lock-in should really not matter. So that takes care of the only Indian portfolio. If you or only focused Indian portfolio, that's the tax saver for you. And the others, we have a Parag conservative hybrid fund. It's in the hybrid category, but we look at it, and we would want you to look at it as a debt fund from our fund house. Here a minimum 75% is we have to invest in debt securities. The remaining we can go up to 15% in equities and up to 10% in REITs or real estate investment trusts and InvITs. Here the concept is that the 75% that we are investing in debt, we don't want to take any credit risk there, or we take very low credit risk there, and that's kind of be the safe portfolio, the safe part of the portfolio. And again, everything, even equities, though they are more risky, the what we are trying to do here is not get into, we want to get into equities which have good cash flow, good dividend yields. So very defensive kind of stocks where dividend yields are really good. So you can call it quasi debt only. And REITs also is, you can call it kind of a quasi debt, in the sense that it gives you rental income and a chance of appreciation of the land price. So uh, we ourselves are very excited about this product, the conservative hybrid fund. I think it's great for people with medium term to long term debt needs, and please consider that as your for your debt investments, the conservative hybrid fund. So yeah, just summarizing, who's suitable to invest in our equity scheme: people with who have a longer term horizon, who can wait for 5+ years at least for the investment. Again, they're not scared of volatility, or they don't check their the NAVs on a daily basis or something like that. You look at it from a longer term perspective. And again, a simple kind of product, in the sense that for us, when we were coming out of the flexi cap, it's like the thought process was that what would we like to invest in, what would be a investment vehicle for us to invest, put in our own money. And we thought that there should be one fund with, we can do everything within that fund, instead of investing in 6 different schemes. If there's one fund to do that, it's a simple kind of a thing. There's less confusion amongst people about the scheme, and that's what we preferred, and that's what we are sticking to. So even the conservative hybrid, it's got 3 asset classes, but in effect, it's, yeah, what would you want your debt fund to look like? And this is the answer we came. The conservative hybrid is kind of what you'd want our debt fund to look like. Again, in the debt schemes, what are we trying to do? We're not trying to profit from every interest rate movement that is there. We are buy and hold pretty much. We are buy and hold. We're not timers of the market in the equity or the debt space. So we kind of usually will hold till maturity. So somebody who's trying to profit from every interest rate movement, then this is probably not for you. Again, debt funds are more liquid and tax efficient option compared to other debt securities, fixed income securities, and again, prefer relative safety of capital. I think one thing for us is that we don't believe in taking too much credit risk in the debt portfolio. That's why the conservative hybrid is great, in the sense that that's 75% to get good return. We don't need to uh, get into credit risk kind of things, get into papers of less quality. Here we can get the 75% can be invested in the best quality papers, and still we can get a good decent return going forward by having some REITs and some equity which are cash flow bearing. And with this kind of a thing, I think we can get pretty good return. That's why we're excited about this. That because this debt product will not have too much credit risk in it, and yeah, it's like I said, we're not very fond of taking credit risk, because credit risk leads to permanent loss of capital. That's the thing. And yeah, interest rate risk is sometimes ups and downs are fine, but if you get stuck in a credit event, then it's very hard for your money to come back. And like I had mentioned, that permanent loss of capital is something that we don't look at very, we don't like that. So plans ahead, surprise, surprise, no scheme launches are planned. Yeah, there's no clarity on opening up of the foreign investment or overseas investments limit. I think, yeah, it's been almost 6 months, but going ahead also, there's no clarity as such. We've not got any communication from SEBI, AMFI, or anyone. I think when macroeconomically, when things look better, I think we'll probably see the opening up of the limits. But as of right now, there's no clarity at all. Again, we continue to focus on what we are doing. I think these 4 funds have each has a need of its own. There's no overlap as such, and I think we'll continue to manage these 4 schemes for the coming years. Again, we think something exciting is there, then we would think about launching something where, like I said, if we can do something different in that category, or in the scheme, and it's something that we are excited about, we'll launch a scheme. Again, what we've realized is that branch expansion or having feet on the street is quite important. Unlike what was said in COVID, that physical office will go away, everything will be online. I think contrary to that is that you need people on the street. You need people in different cities. And for us, I think having branches in some of the metros has really helped us in this in terms of getting closer to our unit holders, our clients, our distribution partners. Um, I think that builds trust over time. So I think we're not going to blitz and have like 30 branches next year or any of that. We'll go slow and steady, whichever cities are showing good growth over the last 3 years. We'll probably think about them and open branches and representative offices there. Yeah, again, one thing that we want to concentrate going forward is to enhance the digital initiatives. There have been things that I've told you all 2 years back, and those have kind of still not happened. And apologize for that. It's been a bit slow on our side. It's obviously also the way the market is for developers and stuff like that. You know that we hired some people and they left very fast, and then we couldn't get more people. And yeah, and people were asking for the moon in the last year or two in the IT space. So that didn't happen as at a pace that we would like, but we will hopefully ramp up now. That things are looking much normal now in the IT space. So hopefully some of the features which are long pending will be addressed sooner rather than later. So yeah, we've got present in the top metros. Mumbai, we've got two offices, one at Nariman Point, one at Andheri. We've got branch offices in Ahmedabad, Bangalore, Bengaluru, Chennai, Hyderabad, Kolkata, New Delhi, and Pune. And we've got our representatives in Nashik, Nagpur, Surat, Vadodara, Chandigarh. I think that's Kochi, Ernakulam, and Jaipur. And over time, we'll add to this list, right? I mean, we do want to get into other cities, other places where we are seeing good traction. So slowly and steadily, we will build up our network too. So yeah, this is the performance table. I think you'll have it in your fact sheet, and I guess Raji will speak more on that. Yeah, just regulatory thing. So thank you from my side. I will invite Rajiv now to to give his presentation. Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.